Good evening and welcome to another episode of NightMarkets, where each week I'll be giving you my perspective on what's driving markets, as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa for SFO. In another week that witnessed a persistent shift in market rotation to small caps and value stocks in particular, the main indices ended with a mixed performance. The Russell indices measured the largest divergence since March 2023 as value stocks outpaced growth stocks by 477 basis points. The week was also notable for a pervasive global disruption to computer systems early Friday, which was caused by an error in a vendor's security update for some users of Microsoft's operating system. So before we move on to markets specifically, let's just have a check-in on the current situation in the Middle East. On Saturday, Israeli fighter jets attacked a Houthi military target near a port in Yemen, resulting in the death of at least 3 individuals and the injury of 87 others. This occurred just one day after a drone launched by the Iranian-backed group struck Tel Aviv, the economic hub of Israel. According to Israel's military spokesperson, the Houthis had utilized the port to receive weapons shipments from Iran. The targets, which were located over 1,700 kilometers from Israel, encompassed dual-use facilities, including energy infrastructure. The latest series of attacks has raised further concerns that it could escalate into a regional conflict. Israeli officials also reported that the strike on Yemen was a result of over 200 Houthi attacks on Israel recently. The United States, meanwhile, has continued to provide support to a ceasefire initiative spearheaded by Qatar and Egypt, which has been unsuccessful thus far due to the disputes between the combatants. Then moving across to markets and starting off in the US, breaking news out on Sunday evening is that President Joe Biden is withdrawing from the race for the 2024 presidential candidacy. The prediction markets are currently pricing in an 80% probability that Vice President Kamala Harris will be nominated as the Democrats' presidential candidate. Both the race for the presidency and the majority in the chambers of Congress remain wide open. The attention now shifts to who Harris will choose as a running mate in the shortest U.S. presidential race in history. During the week, the Biden administration's notification to allies that it was contemplating severe export restrictions if companies such as Tokyo Electron and the Netherlands ASML Holdings continue to provide China with access to advanced semiconductor technology was a significant factor in the underperformance of growth stocks, especially on Wednesday. This information was accompanied by a sharp decline in chip stocks as Taiwan Semiconductor Manufacturing, Broadcom and Nvidia, which is currently the third largest company by market cap, experienced substantial declines. Value stocks also appear to be favored by polls that indicated an increasing probability of a Republican victory in the November elections, evidenced by the value-orientated financial sector appearing to benefit from the potential for reduced banking regulations, whereas industrial and business services shares may have been favored by the possibility of increased tariffs under the Trump administration. The economic calendar for the week offered largely positive surprises, perhaps most significantly retail sales, which exclude the volatile gas and vehicle segments, increased by 0.8% in June, surpassing the consensus and seeing the highest increase since January 2023. In June, building permits passed also increased by 3.4%, which was also higher than anticipated. This marked the conclusion of 3 consecutive monthly declines. In the same vein, the Federal Reserve announced on Wednesday that industrial production had increased by 0.6% in June, which is approximately twice the anticipated growth rate. The Philadelphia Fed reported on Thursday that its gauge of current regional business conditions has reached its highest level in 3 years. The Labour Department's weekly unemployment claims report was the exception on the positive week, as the number of Americans filing for unemployment rose to 243,000, surpassing the 9-month high it had reached the week ending June 8th. The 20,000 increase in continuing claims to almost 1.9 million, the highest number since November 2021, was however more concerning. On the monetary policy front, during a speech on Monday, Fed Chair Jerome Powell addressed the central bank's dual mandate, stating that as inflation has decreased and the labour market seems to be cooling off, they will be more focused on both of these elements in their decisions in monetary policy going forward. The yield on the benchmark 10-year US Treasury note subsequently decreased in tandem with the lowering inflation concerns for the majority of the week, before experiencing a spike on Friday in response to concerns regarding the Microsoft disruptions. CrowdStrike, a cybersecurity company based in the United States that is utilized by more than half of Fortune 500 companies, disclosed that a defect in one of their most recent content updates affected Microsoft's Windows operating system. The company clarified that the incident was not a security breach or a cyber attack. The update that was defective had an impact on the operations of banks and hospitals, public transit systems, and even flights on a global scale. So despite the relatively positive data, as I mentioned earlier, the rotation trade dominated the major indices, as we saw the tech-heavy NASDAQ ending the week lower by almost 4%, along with the S&P 500, which lost almost 2%. The more value-orientated Dow Jones Industrial Average rallied by 0.66%. Then moving across the Atlantic to the Eurozone and the UK, as anticipated, the European Central Bank maintained its interest rates at 3.75% on Thursday. It stated that it would not commit prematurely to any rate path and underscored that economic data would inform its decisions going forward. ECB President Christine Lagarde also stated that a decision in September was currently still wide open, while noting that the risks to economic growth were tilted to the downside. The committee expects inflation to remain around the present levels for the remainder of the year, before declining in the second half of 2025. And for the first time in 2 years, household loan demand increased in the 3 months leading up to June, according to the ECB's Banks Lending Survey. This expansion was fueled by optimism regarding the housing market and easing mortgage conditions. The banks that participated in the poll anticipate that this trend will persist in the third quarter. Eurostat also reported that industrial production in the euro area experienced a 0.6% sequential decline in May, marking the first decline since January. However, output experienced a 2.9% decline year over year, with substantial declines in France, Italy, as well as Germany. And then moving to the United Kingdom, annual inflation remained at 2%, in part as a result of substantial decreases in electricity cost compared to the previous year. The core inflation rate, which excludes the energy and food components, remained at 3.5%. The inflation rate for services, which is closely monitored by policymakers, remained at 5.7%. Additionally, in the 3 months leading up to May, the average earnings, which exclude bonuses, increased by an annual 5.7%. This does represent a decrease from the 6% growth rate we observed in April, and it was the lowest level since mid-2022. However, the indicator maintained a rate that was more than double the Bank of England's inflation target of 2%. And then moving further east, Japan's stock markets lost ground over the week as tech stocks suffered on rising concerns about tighter US restrictions on exporters of advanced semiconductor technology to China. These include several Japanese chip makers. The 10-year Japanese government bond yield decreased from 1.06% at the end of the previous week to 1.04%, amid further rumors that the Bank of Japan may increase interest rates during its July 30 to 31st meeting. This coincides with the intention to disclose information regarding the tapering of its substantial bond purchases of late. The closely monitored nationwide core consumer price index increased by 2.6% year over year in June, a minor increase from the 2.5% year over year increase in May, but it fell slightly short of the consensus estimate of a 2.7% year-over-year increase. The inflation rate, which was anticipated to increase, remained consistent at 2.8% year-over-year. The yen also appreciated during the week to approximately 157.37 in relation to the US dollar, as the government's recent suspected yen buying operations increased. Looking on the macroeconomic front, the government revised its gross domestic product growth forecast for the current fiscal year ending March 2025 from 1.3% to 0.9%. This further underscores the country's economic vulnerability. The downgrade was largely due to the yen's weakness, which resulted in higher import costs and sluggish domestic consumption, which in turn eroded the purchasing power of households. During the week, the Nikkei 225 fell by 2.7%, and the broader Topix index was down by 1.2%. In China, equities rose as investor sentiment seemed largely unaffected by some weaker than expected economic growth in the second quarter. The second quarter saw a 4.7% increase in China's GDP, which was lower than the consensus estimate. This was a decrease from the 5.3% growth that was observed in the first quarter. The economy expanded by 0.7% on a quarterly basis, which is less than half of the revised 1.5% expansion that we saw in the first quarter. Additionally, other macroeconomic data out in the week also underscored the economy's vulnerability. Retail sales experienced a less than half than anticipated 2% increase in June compared to the previous year, a decrease from the 3.7% increase we saw in May. This decline was partially attributed to declines in sales of domestic appliances and automobiles. Industrial production increased by more than anticipated 5.3% in June compared to the previous year, but the pace of growth was slower than that of May, when it increased by 5.6%. Also, fixed asset investment increased by 3.9% from the previous year in the January to June period. This was more or less as expected. However, property investment decreased by 10.1% year-over-year. On the employment front, the youth jobless rate decreased to 13.2%, which was the lowest level since December, while the urban unemployment rate remained constant at 5%. According to the Statistics Bureau, China's new property prices experienced a 0.7% decline in June, which was consistent with a 0.7% decline observed in May, and extended the period of decline for the 12th consecutive month. The data did indicate that the property market slump, which has emerged as a significant growth headwind, and has left the economy reliant on exports for development, has been little affected by the historic property rescue package that Beijing unveiled in May. And then moving back home, locally, the week was dominated by monetary policy news. The Monetary Policy Committee of the South African Reserve Bank completed its scheduled meeting on Thursday, and announced that they decided to maintain the repo rate at 8.25% despite the recent strength in the rand. The decision to maintain rates at the current level, which was widely anticipated by economists, was not unanimous, however. 4 policymakers voted to maintain the current rate, while 2 preferred a quarter-point rate reduction. The economy in the first half of the year was described as disappointing by policymakers in the post-meeting press conference. They anticipate that growth will, however, remain below longer-run historical averages in the medium term, despite the expectation of somewhat faster growth. In terms of inflation, policymakers acknowledged that the 5.2% number that we saw recently was an improvement, and that they do expect inflation to fall below the 4.5% midpoint of the inflation target range as a result of the reduction in food and petroleum costs over the next few quarters. However, central bank officials believe that the balance of risks was still tilted to the upside, which led them to maintain the current short-term interest rate. They specifically identified electricity inflation and elevated service price inflation as areas of concern. And looking at the market performances, the all-share index ended the week lower by more than 2%, with the industrial sector falling by more than 3%. The rand also ended the week weaker at 18.25 to the US dollar. And then just looking at the week ahead, the week ahead will be a busy one with US inflation data that could potentially reinforce anticipations for a rate cut in September, which will probably be taking center stage. Economists are expecting June's personal consumption expenditure price index to have climbed 0.1% for the second straight month, which would bring the 3-month annualized core inflation down to the slowest pace this year, and also below the Fed's 2% target range. Additionally, the first of the mega cap stocks, which includes Alphabet and Tesla, as well as a swath of European banks, are due to report earnings, kicking the earnings season into high gear. While economic growth in the Eurozone remains sluggish, strength in the dominant services sector boosted by tourism has kept price pressures uncomfortably high. Consequently, the possibility of the next European Central Bank rate cut will be more clearly defined by some PMI data from the Eurozone out on Wednesday. Locally, the highlight of the week will be the inflation data on Wednesday and Thursday, which is expected to print in line with the previous month readings. And then, as always, we'd like to end off with an interesting investment idea we've been discussing during the week, with the rotation trade seeming to pick up steam of late. I think it once again highlights the importance of diversification within an investor portfolio. With flows into passive strategies dominating the landscape over the past number of years, we think active managers could possibly start to add alpha once again as the market rotates away from more passive strategies into more active strategies. Thank you for joining me for another episode of Night Markets. Financial markets close at 5 p.m. Night markets open at 6 p.m. Let's start the conversation.